in our studio, we have several monitors. And so up on CNBC right now, they're showing Google Trends relating to two terms, right? The yield curve and recession. And this has been something that nobody's really talked about over the course of the last 5 years. You know, the potential for a recession was not something the media would even talk about. And of course, this has been all over the news over the last week because of the inversion of the yield curve. And now all of a sudden, these are the main talking points, right? When CNBC runs a headline that says markets in turmoil, you know pretty much that this is a crisis moment for the media, right? And this is what we saw last week. The yield curve inverted, market in turmoil banner came up, and of course, markets were selling off 400 or 500 points, and all of this was on the back of this yield curve inversion. Talking about the potential now for a recession is really picked up, and they're surprised now that there's been a massive pickup in people searching about recessions and yield curves. Like, how many people understand what a yield curve is anyway? So, is that a left curve or a right curve? I'm not quite sure. Target came out, and Lowe's came out this morning reporting better than expected earnings. Good things. So immediately the headlines have jumped from yesterday we're going to have a recession because of the yield curve to, oh, there's no recession in sight today because, well, obviously Target's doing well, so people are shopping. Be a little careful with that. First of all, earnings data is very lagging. Also, the fact that we lower expectations dramatically leading up into the actual earnings announcement so that the companies can actually get over earnings. And so when we beat these lowered bars, everybody goes, "Oh, this is amazing! It's important. It's good. This is positive. Consumers are out there spending, absolutely." But be careful with that too, because as we head into any recession historically, retail sales have actually generally always upticked right before the recession. It's almost as if people kind of sense that something's happened, so they kind of stock up on stuff because they're concerned about what's about to happen. So you generally have these little upticks in retail sales, employment. Also, a lot of the other economic indicators will see a slight uptick right before you actually slip off into recession. Recessions tend to be a self-fulfilling prophecy. When the term recession and yield curve starts to become mainstream and everybody's talking about it, well, this is where people make decisions to basically, well, maybe I won't go out to eat tonight. Maybe I'll postpone buying that new car I was thinking about. Maybe I'll just save a little extra money this month rather than spending. It's those small, minute adjustments that people make that actually impede economic growth and then lead you to a recession. And recessions aren't a bad thing, and this is the interesting part because, recessions are actually healthy for an economy because what that allows for is for the economy to kind of reset itself to, build up some pent-up demand and so that you can have the next growth cycle in the economy. We're petrified of having a recession because psychologically we remember the last one still. And for a lot of people, that was a very painful experience back in 2008. They lost their house, they lost their jobs. And so people remember that pain, that agony of the recession. So we certainly don't want to go through that again. This is why the 60-40 portfolio is dead now. A big part of the return over the last 40 years has been in the fact that yields have been falling. We were, in the 1980s, we were getting 10, 11, 12, 13, 14% on treasuries. You buy a 10-year treasury, you get 14%. 30 years, you just lock it up and go home, right? There's no work to be done when you're getting paid by the government 14% on your money. Well, all those have now expired. Now, listen to me here very carefully because everybody's talking about the fact that the bond bull market is over and that rates are going to rise. What if this is the bell that's marking the top of the market for this particular cycle? And that's the question that investors need to answer. It's also the question that the Fed has to deal with. One last point here is keep watching oil prices. There's a very high correlation between the direction and trend of oil prices. And here in Houston and Texas, we know this more than anything else. There's a very high correlation between economic growth, inflation, and interest rates relative to economic growth and oil prices. And if you pay attention to oil prices are telling you, along with small cap and mid cap stocks, along with stocks outside the US and outside the S&P 500, all those indicators are telling you that there's something wrong within the economy, yet investors are focused on the bell in terms of trying to make their financial decisions. They can't rise. Read my lips. Rates cannot rise. When you have as much debt in the system as we have now, and when you have a U.S. government with absolutely no fiscal responsibility and having to issue $2 to $3 trillion of debt every year just to fund spending and just to keep the economy going at where it is, you cannot have a hike in rates, because as soon as rates go up, everything else stops. We saw a marginal increase in rates last year. We went from 2.5% to 3.25%. Housing stopped, auto sales stopped, the economy slowed down. That was on a 75 basis point increase in rates. Can you imagine what happens to the economy if rates actually did go up 1 or 2 or 3%? It would be absolutely economic devastation, from pension funds to portfolio managers to markets to the economy itself. And that's why rates can't go up, and they won't go up. I bet you I have a topic for your college funding class that you're not going to cover.
What's that?
How to get access to government-sponsored grants and college funding.
Oh, well, tell me.
You've got this problem coming up, right? Because you make too much money, and you've got 3 kids
Well,
to put
I don't know
through college.
about that, but yeah.
and you're not going to be able to qualify for, a lot of these grants and scholarships that are based on family incomes.
What are you here?
Well,
what are you advocating for here? You disown your children, or?
Close. Rich families are basically finding poor relatives, and they're transferring custody of their children to those relatives, and then applying for college grants through the custodial parent.
Oh man,
there's always a way to game the system.
Exactly, and so this is the new thing. So the wealthy parents were buying their way into the colleges, and they got busted.
Movie stars.
Yeah. So they all got busted for that one. So the new scam is to find. Why are you laughing? This is a true thing.
I'm just thinking about who I can get my kids to. What are you talking about?
I'm already working on this. So Connie doesn't know this yet, but when he gets to work today.
Oh, man.
He thought he's just going to have 2 kids.
Exactly. Surprise! Got 4 more.